Hello there, wealth builders. This is your king speaking, and you're watching Elite Finance King. Welcome to the Pride. Let's get into it. Today, come along with your king as we embark on a thrilling journey to explore the exciting world of two of the best investment options that have been on everyone's radar: ETFs and index funds. Wealth builders will dive deep into the intricate differences and striking similarities between these two, helping you understand which one aligns more with your financial goals. So, what are you waiting for? Get your pen and paper and let's get started. Before anything else, wealth builders, let your king define first what an index fund and an ETF are. An ETF, or exchange-traded fund, is a type of investment fund and exchange-traded product. ETFs are similar to mutual funds, but they trade on stock exchanges much like individual stocks. ETFs can offer a broad range of investments too, including stocks, bonds, and commodities. An index fund, on the other hand, is a type of mutual fund or ETF that aims to track the performance of a specific market index, such as the S&P 500. Index funds are passively managed, meaning they seek to replicate the returns of the target index rather than outperform it. Now, to help you understand these two better, let's discuss the first difference between ETFs and index funds, which is all about their fees and expenses. Wealth builders, ETFs typically have lower expense ratios compared to mutual funds, which can make them a cost-effective choice for investors. This is because ETFs are traded on stock exchanges and therefore do not have to pay for the costs associated with buying and selling securities. Additionally, ETFs often have lower management fees since they are passively managed, which means they simply aim to replicate the performance of a specific index without the need for active management. On the other hand, index funds may have slightly higher expense ratios due to their structure as mutual funds. However, it's important to note that the expense ratios for index funds are generally lower than actively managed funds, since they are passively managed and simply aim to replicate the performance of an index. Index funds are a popular choice for long-term investors, like your king here, because they provide broad market exposure at a relatively low cost. They are also easy to understand and manage, making them a great option for beginner investors. Alright, the second difference between these two is all about minimum investments. Wealth builders, when it comes to minimum investments, ETFs and index funds have different requirements. ETFs, being traded on stock exchanges, can be purchased with increments of a single share, which makes them accessible to investors with smaller amounts of capital. This flexibility is one of the reasons why many investors, particularly those who are new to the market or have limited funds, are drawn to ETFs. In contrast, index funds may have minimum investment requirements that can range from a few hundred to a few $1,000s. This higher minimum investment can be a barrier for some investors, especially those who are just starting out. However, it's worth noting that many index funds have lower minimums for investors who commit to making regular contributions through a 401k or other retirement account. In this way, index funds can still be a great option for long-term investors who are looking to build a diversified portfolio over time. Another key difference between ETFs and index funds lies in their liquidity. ETFs, as traded securities, have high liquidity and can be bought and sold throughout the trading day at market prices, which fluctuate during the day. This allows investors like you wealth builders to take advantage of intraday price movements and execute trades at their desired price levels. Additionally, ETFs can be short-sold, providing investors with more opportunities to profit from both rising and falling markets. Conversely, index funds are bought and sold at the end-of-day net asset value price, which means that investors cannot take advantage of intraday price movements. This can be a disadvantage for investors who are looking for more flexibility and control over their trades, particularly those who are interested in active trading or market timing. However, for long-term investors who are focused on building a diversified portfolio and are not concerned with short-term market fluctuations, this limitation might not be as big of a deal as it seems. Now, wealth builders, despite their differences, ETFs and index funds share some key similarities. Let your king elaborate on them. Firstly, one of the most significant similarities between ETFs and index funds is mentioned earlier. They are both passively managed. This means that rather than trying to outperform the market, these funds aim to replicate the performance of a specific index. This can be beneficial for investors as it can result in lower fees and expenses compared to actively managed funds. The lower fees are because these funds do not require a team of analysts and portfolio managers to make investment decisions, which can save investors money over the long term. Secondly, both ETFs and index funds offer diversification, which is why your king loves them both, because diversification is a crucial component of a well-rounded investment strategy. Wealth builders, if you don't know it yet, diversification involves spreading your investments across a broad range of assets to reduce the impact of any single security's poor performance. By investing in an ETF or index fund, investors can gain exposure to hundreds or even thousands of different securities in one fell swoop. This can help us big time to spread risk and improve the overall stability of our portfolio. Lastly, both ETFs and index funds are known for their tax efficiency. This is because they generate fewer taxable capital gains compared to actively managed funds. This is due to their passive management style, which results in less frequent buying and selling of securities within the fund. This can be a significant advantage for investors, as it can result in a lower tax bill, allowing them to keep more of their hard-earned money. Furthermore, ETFs can be particularly tax efficient due to their unique in-kind creation and redemption process, which allows them to avoid triggering capital gains taxes. Now we have reached the final part where we discuss which investment option is more suitable for you. All I can say as your king is that it's very important to carefully consider your investment goals, risk tolerance, and investment horizon before making a decision. If you're an investor who values flexibility and liquidity, and you're looking to take advantage of short-term market movements, then an ETF might be the better choice for you. On the other hand, if you're a long-term investor who is looking for a simple and cost-effective way to invest in a broad range of assets, then an index fund might be a better fit for you. Ultimately, wealth builders, the choice between an ETF and an index fund will depend on your individual investment needs and preferences. It's always a good idea to speak with a financial advisor to help you make the best decision for your situation. There you have it, wealth builders. If you found this video valuable, please like, subscribe, and share it with your fellow financial dreamers. Your king here loves that. I'll see you next time. And always remember, Pride members, life is short and it's too easy to be average. Make a change today.